again, another amazing session with me and other legal colleagues. So hopefully you wouldn't get too bored. This one is about DeFi. Hopefully a little bit more interesting than all of the other typical regulatory sessions. We're almost done with the first question. We were actually supposed to introduce ourselves, but and I will switch then directly to the topic of staking. What we are going to do, basically, we are going to cover major DeFi use cases or things which fall under DeFi and which have some regulatory consideration, and go through them one by one, giving our opinion on like Switzerland or EU. We have amazing Vyara. We have also Anne Grace with experience in EU. Regulated, not regulated, should be regulated, and what are the major risks for the projects. I would suggest we jump directly to the topic of staking, which has been widely discussed in Switzerland and also in EU. Whatever you feel you would like to tell us about the staking, maybe giving a quick overview on how it is regulated in Switzerland, how and whether it is regulated in EU. Whoever feels too comfortable to start first, go ahead.
You mentioned Switzerland, so let's jump into that. And first of all, staking, we use it for everything. Say it was stake. You stake for governance, you stake for like proof of stake. So the first thing to be identified is what kind of staking are we referring to? Is it something that's required technically, that you generate like additional tokens because you staked something in context of proof of stake? Is it staking for governance? Is it staking just for the sake of staking so that you can generate some yield and it has no utility at all? From a regulatory perspective in Switzerland, people just look at how close it is to staking in POS. Is it required from a technical perspective? Is there any activity being done that justifies why you receive additional tokens at the end when you stake? And once you answer these two questions, you can kind of assess the risk of this being considered a regulated activity or not. Obviously, on top of that, you have this whole idea of how is the yield distributed? Is it just someone deciding that if you stake long enough, will manually distribute tokens to you? Is it something that's fully automated? Who can decide to change the parameters? So this is very important as well. And in general, just checking what is the technical setup behind it, and then how is it advertised? Because maybe you decentralized everything from a technical perspective, but bad luck, you decided to advertise it in a very centralized manner by saying, I'm offering you a specific yield if you stake long enough. The major rookie mistake, just advertising something with a lot of enthusiasm that has regulatory implications.
Yeah, perhaps I can jump in with the EU perspective, and I'm really happy that that's the third panel after your two amazing discussions, because I will step on to what you said and say with Mika, the biggest question right now around DeFi in the EU is what even is DeFi? What is decentralization? What does decentralization mean under Mika? Because some of you might know that theoretically it is exempted from the application of the regulation, but then no one actually knows what DeFi would mean when Mika is applied. And it is applied on a member state level, so that makes it even more complicated because there isn't a centralized understanding and kind of a centralized way of this information to be adopted in a unified manner. So it would all boil down to how your national competent authority would understand decentralization and if it even can be convinced that decentralization exists. And what we have so far in the EU are a few guidances, particularly when it comes to what is DeFi. The Danish authority paper that Anne-Grace already mentioned is a very interesting one because it's the first one when a national competent authority, the one in Denmark in this case, is saying this is what we consider to be decentralized and this is how we perceive that regulation and any regulatory steps should be taken further from here. We also have, of course, something that Justina mentioned, the EBA ESMA paper around what is decentralization, how it's perceived. So those are guidelines for us as an industry, but now the real test would be how would national competent authorities really understand decentralization. So we'll keep you posted because we're kind of following this on a member state level.
I think what is interesting when it comes to staking is if we look at how staking got regulated in Switzerland. In 2023, there was an event where the Swiss regulator FINMA participated, and there they stated that anyone who is doing staking services would require a banking license. That resulted in a huge, let's say, drama in the industry, and an initiative from different blockchain associations and federations here in Switzerland. And what was very interesting is that the market participants and the associations here in Switzerland were able to convince the Swiss regulator FINMA to reconsider its approach, even though it was not legally binding what they said. Then they issued in December 2023 the staking requirements, and it is not anymore required to have a banking license in order to provide staking services. But I think it was very interesting, a very interesting use case of staking regulatory approaches, and a success for the industry that they were able to convince the Swiss regulator FINMA to not be so harsh when it comes to the requirements. Otherwise, staking would have not been possible in Switzerland really, because anyone who would have done it would require a banking license. I mean, I work for Stingam, the world's first digital asset bank, and we also provide staking services. But if we think about DeFi and staking, in this case, it's not truly DeFi, because it's centralized with a bank or a service provider. So there are different, I would say, use cases of staking. Some can be considered DeFi, others wouldn't fall under the DeFi understanding.
Thank you. And maybe to add to that, I'm not sure if I would completely agree with you, Magdalena, because I think the FINMA guidelines, they clearly only apply to staking as a service. So if we stay true to the word, what is staking? Anyone can stake their tokens if they are stakeable, and this can be done on your own, and there no regulation applies, at least in Switzerland. What is of concern, or what was concern to FINMA, was the connection between staking and custody. So they said, if I give my tokens to someone to stake them, and this someone has control over them, then regulation might apply. And I think the crucial point here is whether or not these tokens, once they are given to this service provider, if they are held readily available, i.e. if they can be segregated in an insolvency proceeding against this service provider. So this has been the optic of FINMA. It was, let's say, protection of the consumer, so that he's not exposed to the insolvency risk of the service provider. So, I think it's really interesting how he tackled that, because for once we have this aspect of, you know, you need a regulation as a bank if you hold these tokens in custody in a way that they're part of the bankruptcy proceeding, of the bankruptcy estate. On the other hand, he said, well, listen, banks, if you offer this service and you don't hold them readily available for your clients, these assets will be considered on balance sheet and then subject to the regulatory capital requirements, which are quite brutal in connection with crypto assets. So the guideline is structured in a way to give incentives, foremost to banks and, let's say, safe havens, how to structure their staking as a service business in order to avoid these capital requirements. On the other hand, I think it offered some clarifications what can be done and cannot be done. And I think if you're not a bank, the bottom line is a bit harsh, because you can only offer staking services if you segregate the stakings per customer. And for example, with Ether, most customers are just not big enough to offer this on a segregated basis. So I'm not sure, it's good to have these clarifications, but I'm not sure that it was done in a way that is very market friendly. It is certainly bank friendly, but
I mean, thanks a lot for that clarification. Of course, if an individual is staking, that is not subject to regulation. That is clear. But I think what was interesting about FINMA's approach, and this time we have a lot of we have quite a few players here in Switzerland, like Bitcoin Swiss. They are providing staking services, and based on the FINMA previous approach, it would have been difficult for them without a banking license. And I mean, for us, we have a banking license, we can do it. That would not be the issue. But I think it's great that they have reverted their initial approach to enable more business compared to what, the previous approach would have made possible.
Maybe just to quickly jump on it, because it's very interesting and the nuance you added and like this discussion on staking at the end, because we are on a DeFi regulatory panel and we end up mentioning a business and service providers. And maybe it's interesting just to differentiate like centralized entities providing a business and a service where you give access to something that's supposed to be a public good to start with, and you add a layer of complexity on top of that, which is something to be differentiated because people say, oh, I'm using DeFi. How do you access that? Oh, through that app that I have on my phone. Well, is it still like a DeFi? How do you perceive that and how do you regulate this interaction? That's the interesting part, because like true DeFi, just you interact with the protocol directly, you connect your wallet, that's one thing. But then there are so many services that just bundle it up together where the questions are completely different. When we say staking, what do you mean? How do you access that staking? What do you do concretely? It changes everything.
That's actually very true, and I think we can spend a lot of time on talking about what is DeFi and what is not. I think when we, at least, not sure about the EU, but from a Swiss regulatory perspective, FINMA doesn't really care if it's centralized or decentralized. They say same business, same rules. They say we have a technology neutral approach, which is not entirely true if you look at the law, but that's their statement. And back in the days, Mark Branson, the ex-director of FINMA, made this duck test where he said, if it queaks like a duck, swims like a duck, and looks like a duck, we will treat it like a duck. And I think FINMA has the same approach with respect to DeFi. Now the problem is, what is the duck here? And there are a number of issues which I'm still struggling to get my head around it, because we have no centralized, so just localizing a business that is decentralized is difficult, and maybe we need to add a layer of regulation or some more guidance with respect to localizing a decentralized protocol. And I've come across decentralized protocol where 80% of the governance tokens were held by the same two people. So is this still centralized or not? And honestly,
DeFi washing.
DeFi washing, good. Maybe you have to get into this, yeah.
If it is, I'm not sure I would agree that FINMA doesn't care about decentralization at all, because if it's a duck but there's no owner of the duck, FINMA will say like, okay, there's no one I can reach out to actually control that duck. So I would say it's kind of cares to a certain extent. Well, they would say, okay, what do you do with that duck? Are you providing that duck and offering that duck to people?
I mean, what FINMA said in its annual report 2021 is how it's going to treat DeFi. And there it mentioned its same risks, same rules, as you said, and technology neutral approach. But when we look at DeFi, I think what we can see nowadays is that many DeFi projects have an element of centralization behind. It's not truly decentralized. And if you are conducting financial services or intermediation, putting the label of DeFi without being truly DeFi, then this is subject to regulation. And I think this is also a very valid point from the regulator on how to approach it. Fabian Scher, professor from University of Basel, he has an interesting DeFi stack where you go through all the layers like settlement, asset, protocol, application, and aggregation layer, and then you look at each element, and based on that you can actually assess, is this truly decentralized or not? This is always helping me when looking at DeFi projects.
Yeah, perhaps I can just sprinkle some EU knowledge or further confusion to the conversation. But basically how, that's especially visible from the Danish paper that I mentioned, what is the current approach and what we expect to be the, at least one of the approaches when it comes to evaluating what is DeFi is, and who would be responsible for that DAC without an owner, it would be mostly who is providing the front end. Basically, the entity, the person that is building or has in some way publicly made available the app or the front end, the web front end that is used for for accessing this app. So, and that is very much aligned with how the European Union is perceiving those problems, especially with things like the product liability directive, where software is also a product and software developers have a liability, but that's a different panel. So they're also going after the entity or the person that has put this app, this software, basically, that has made it openly available to the public.
Yeah, just to refer to this point from one of the EU regulators, what they have to quote them what they have said in public. If we can grab someone behind the protocol, then then it's not so. It is what matters to a lot of regulators. They have a different optics. They always have to have someone whom they can make liable in case of hack, in case of funds get stolen. You always have to look at them with this optic. Just to sum up on the staking topic in Switzerland, I think it was really a great victory of the community. I've been at this event in September, where I think Matthias Obricht was who announced this practice, and then we were all shocked because it would have been extremely unproportionate. And then it was a lot of work of the associations, and that's really a great example of, I would say, even lobbying or educating, whatever you call it. What I also wanted to, let's say, to make it more practical, to see what are major regulatory considerations or issues with so-called staking pools or yield farming from Swiss and EU perspective, so that the projects here are aware for staking. There is an approach for native staking, for staking in general. There is an approach in Switzerland. There is no, let's say, unified approach yet in EU. What about yield farming, liquid staking pools?
Yeah, I'm holding the microphone. Yep. So what I can already say is that there are attempts to understand it better. At this point, this is what has been done on the EU level. In terms of context, there is MiCA, but you might have already heard about MiCA 2, because even before the original, the OG MiCA was applicable, there were already discussions on, okay, how we can expand this. So there is, in the text of MiCA, already this deadline that was recently missed by the European Commission for them to issue a report on the novel adoptions in the industry that need to be put under the MiCA framework, and among those was DeFi and NFTs and so forth. So for that report to be drafted, there is the need for an input from the European Banking Authority and the ESMA, European Securities Market Authority. So it was recently published, and they are saying in this text that they are not pushing specifically for any regulatory changes, but we need to keep in mind that whatever is publicly available, it would at some point influence whatever is going to happen with MiCA and MiCA 2. However, crypto is not currently the main focus of the European Union, thank God for AI. And we are not expecting MiCA 2 anytime soon. But what they're posting there, what they're saying, particularly about staking, liquid staking, they're understanding very well the difference, what it means, restaking, liquid staking, and so forth. But what they're saying is that at this point, we are not considering this such a big issue in the EU because the adoption has not been significant. So it does not have this possibility of influencing negatively the TradFi market and the broader market, and therefore it's not a big concern for consumer protection. So that's the stance at the moment. But again, what is DeFi and what is outside the scope of the OG MiCA, that's a completely different story.
Maybe to add to this and what you said previously, those Danish guidelines are not bad at all, I would say, to the extent they highlight that you need to check in the first place whether the activity is regulated. So what do the smart contracts do? And the parts that are being controlled in a slightly centralized manner at least, is it regulated? Because if you offer a whole service that is supposed to be regulated, that no one controls, and then let's imagine the only centralization points is your rewards campaign on top. Well, clearly it's not relevant. You will not regulate someone because of a rewards campaign as controlling the whole ecosystem. So like having this idea of let's verify what is being done, what are the key functions that constitute the financial service, and are these being controlled, actually makes sense. And it's the same for interfaces. Like they will look at the interface, but only to the extent they provide like a layer, an additional thing. If it's just a neutral access point without any smart contracts facilitating the access and so on, it's not exactly, I mean, maybe we have a different understanding, but the way it's written, as I said, if it's just completely neutral and adds nothing to the service, it's going to maybe be under scrutiny because it gives access, or like there may be AML considerations, this is different, but just you will not be regulated as a bank just because you give access to a protocol that you do not control and that does this. So it's all about what does the smart contract do at the end. It's not the whole thing, but let's put it into compartments based on the functions of the smart contract.
Absolutely, but let's get this one practical to liquid staking. I really want you guys to speculate on that, bringing you back to the subject, because this is relevant for the audience, because that's what they do, and they are not, sometimes, most of the cases, they're not aware of the consequences. Yeah.
Well, maybe I can give some inputs based on our practice. So I fully agree. If it's only a fully decentralized smart contract that's somewhere, it's hard for a Swiss regulator or for a EU regulator to touch on that, because where is it? Then we have different issues. We usually come across these phenomena when you have asset manager type of entities or of structures that they create a smart contract, for example, for yield farming, and there they want to offer that obviously or often against a fee, and maybe they have a seed, some kind of entity in Switzerland, and then you have some kind of attachment to Switzerland, and this is where we come into play. And from a regulatory perspective, I think in respect to yield farming, there are two main concerns. The first one is the Collective Investment Scheme Act. As soon as you're accepting, and here you have to keep in mind this is a regulator looking at it. I know that you're not accepting it; it's somewhere in the smart contract. But from the regulator's perspective, it's you that accept it or has control over it at least. So if you accept funds and pool them in somehow, this gets you into the realm of a collective investment scheme. And in our experience, the crucial point is, does someone have a function as a manager? So this can be passive or active. So even if you have an algorithm that channels the funds or the tokens to the relevant liquidity pools, this can already be seen as a collective investment scheme. And here you have to keep in mind that also passive funds are investment funds. So there's no way out to say, well, I didn't do anything. It's the algorithm that decided. More complicated are structures where you have let's say, a governance mechanism. So where you say if you have a community that decides on the allocation, and there I think the crucial point would be to look at this community. How is it being decided? I mentioned an example before. If you have a community where two people are deciding, well, I'm not sure that you can say we're truly decentralized. The second relevant regulation is often banking regulation. So keep in mind, if you accept or if you run a project where you accept tokens and you have control over them, you will need to ensure that these are that they are able to be segregated in an insolvency case. Otherwise, you run into issues there. That's all on my side.
Thank you a lot. You really brought it to the point, because those liquidity pools, especially when set up without any formal entity, as we have seen in the case of recent case, I believe, of Lido. We just had this discussion. I was like, okay, that's fun. We just had this discussion with Lido in Sofia, whether to have a legal wrapper for those projects, even if not in a regulated jurisdiction. Switzerland or EU approach is similar. It is very close to collective investment scheme because you pool funds, and then somehow at a certain point you provide third-party management, even if you set up this strategy once or is set up algorithmically. Regulators tend to see it as collective investment scheme. And so a practical approach has been so far to separate the liabilities from the founders. It is an open secret. People use some of the offshore structures, but it is a practical advice. At least you separate somehow, or try to separate the liabilities from yourself, from the team. While in case of LIDAR, we have seen another regulatory strategy, I would say, where you just try to stay non-visible, but at the end of the day, if the regulators, investors, or whichever interested party it could be, try to grab someone, then they make those persons liable directly, because they didn't have any legal wrapper.
Maybe just.
But this is a practical case, and there was a bunch of those cases ongoing. It's just, yeah. Mm-hmm.
Maybe to add to that, once you're dealing with a DAO, this aspect of personal liability is also an issue in Switzerland as the fallback solution. If you don't have any other form of entity, or you don't fit into another form of entity, would be a simple partnership, and there you're liable. Every simple partner is liable. So to avoid that, I would recommend you to create some kind of DAO wrapper. There are some entities that are or some structures that are well suited for that. I think there are also specialized legal entities for that purpose, for example, in Wyoming, and I think also the foundation of the Cayman Islands can be used for that. But also don't neglect Swiss law. The Swiss association is very flexible, so it's a suitable form for FIFA. It can be also suitable for DAO, and depending on the project, also a foundation can make sense, especially if you are holding some kind of assets on trust. This can be useful, and it can be hard to implement these wrappers once you started the DAO. So these are, you should think about it before setting up.
Maybe just to quickly jump on that, basically the question is, how do you generate the yield at the end? The more active you need to get involved to generate it, the higher the risk. Then the second thing, we mentioned wrappers for DAOs. Now we have a new type of wrapper that everyone comes up with. Oh, it's the AI agent. I love, like, DAOs are no longer the way they protect themselves. Like, oh, it's AI. The thing is, if it's run on a centralized server, we kind of end up with the same kind of questions. And then regarding DAO wrappers, some people think that if they get like one of those creative wrappers like Wyoming, the Marshall Islands, we're definitely DeFi because we got the DeFi wrapper. Well, the thing is, none of these regulations have thresholds for like decentralization. So you could still set this up, have token holders, and then it turns out that 75% is still held by the same person. So there's like, it's not a stamp of decentralization from a governance perspective. It just means that the structure is built in a way that is allowing you to be decentralized. If you use it in a centralized manner and hold all the tokens even, no one will be able to like even check it. It's not because you are a Wyoming entity that this is guaranteed. So these were like the 3 points maybe to jump on that.
I think I would like to go back to the personal liability point, which I think has been very well demonstrated in the case of Tornado Cash. Because after the OFAC sanctions in August 2022, it was the developers of the smart contract, which is immutable, that were subject to prosecution, that are serving jail time because of personal liability as the software developers. So yeah, that is quite an extreme case, but just be aware that even though someone is designing something in a way that it is truly decentralized, there can be still authorities going after the individuals behind.
No, that's a true. This has been, well, I mean, we've been discussing mainly, let's say, civil law liability for investment DAO or for those liquid staking pools. In the case of Tornado Cash, I think it is extremely unproportionate. It was extremely politically influenced. And in my opinion, in other countries of Switzerland, I wouldn't have imagined such an unproportionate law application in this case. But this, yes, this in a very, very worst case scenario, if let's say it is a political decision in place, yes, this can be the case, and that's why a lot of developers of those projects try to stay anonymized as much as they can, and this is justified.
It's also the difference that you just develop, put it in a public repo and left it for everyone to use however they want, or are you kind of involved in promoting the use of that? That's also the major question, because as soon as you get involved, well, first of all, it's a bit more complicated to stay anonymous, and then also you're influencing how people use it, which makes sense. Like, you have responsibility because you did not only, I mean, people always gave the example of guns. It's not because you build a gun that people necessarily kill with it. It's the same with the protocol, but if you sell them by presenting them in a certain way, or you just sell them to a specific audience, well, it kind of influences the use. So this is one of the questions as well, like, beyond building it, what have you done subsequently?
Magdalena, do you have something to add? No. We still have some time to go. Do we want to jump to questions, or can we still discuss last one? Because what's your, let's say, take on peer-to-peer exchanges and AML issues? Because I believe this is also one of the key problems of DeFi, and the projects need to be aware, especially the developers, of their, let's say, worst-case personal consequences.
I have a take on that, for sure. I mean, I've been doing crypto compliance for more than 6.5 years here in Switzerland with regulated crypto-native companies, currently at Signum, before that at Crypto Finance. And the experience I made, especially with the regulator when it comes to DeFi applications, be it borrowing and lending or decentralized exchanges, the regulator is, even though you're interacting with a smart contract, the regulator wants to know who is everyone behind the interactions of a smart contract. So AML and KYC are very important. And at this moment in time, we see more compliance functions built into DeFi setups and use cases and applications. I would expect that to increase in the future further. I think with self-sovereign identity and zero-knowledge proofs, we have very interesting use cases to apply to DeFi. But if anyone wants to offer services, financial services with DeFi, it will only be possible if it's known who is participating in that protocol or interacting with that decentralized exchange. Has that person been KYC'd? Has sanction screening taken place? So this is the insights that I can share based on interactions with the Swiss regulator FINMA.
So yeah, from the EU perspective, we are once again, really prepared with regulations that cover pretty much any topic that you might think of, including soon there's going to be something interesting about DAOs, but yeah, I'm going to probably share about it more next year because it's not public. But when it comes to AML, it has been something like rule of thumb that AML terms everything privacy related. So this is very unfortunate because I'm a privacy lawyer. That has always been an issue with me. But also when it comes to AML and particularly the transfer of funds regulation, that it has become applicable at the same time as MiCA. All those deadlines that an extended periods, the grandfathering periods do not apply. So even if you are like excluded from MiCA, you might still fall under a lot of AML regimes, and this also takes DeFi into account, particularly when it comes to the so-called quote-unquote unhosted wallets, self-hosted wallets, what we just call wallets in the industry. There is now this necessity of providing information each time you're basically connecting with a crypto asset service provider. Whenever there is a wallet like this involved, you need to provide certain information, and there is not a minimum threshold, because with traditional transactions there is always a threshold. In this case, there is not. The only threshold basically is that above €1,000 you will be expected to also identify if the person that you are transacting with is actually the one holding the wallet and is not just claiming that. So there is now a lot of, I would say, business for different tools that help CASPs provide this type of information and confirmations. But AML requirements are there, and even if your project, for example, would not necessarily fall under MiCA, it is very likely that it already falls under certain AML requirements. Would it be transfer funds regulation or the directive or the regulation?
Maybe one point that we come across often, I think it's, we agree that AML is usually applicable to exchanges, and this would also apply to decentralized exchanges to the extent they were considered to be in a certain jurisdiction. The issue that I see in Switzerland is that these AML regulations that are in place, they cannot be really met in a DeFi manner. So I think with the technology, we would be able to create the best KYC in the world. Everything is public on a blockchain after all, but these measures are not in compliance with the current regulation, and this has as consequence that we are dealing with SROs and FINMA, and I don't know if you've ever talked to people in charge there. They're not the most flexible in my view. I'm sorry if someone is in the room, happy to discuss this further. But so they're really focused on the old world, and I think in order to have a proper KYC and AML in the DeFi space, we would have to embrace new sorts of or accept new forms of regulation.
Actually, this is what my PhD is about. I am trying to propose how zero-knowledge proofs can be used for AML KYC purposes, and how the current laws need to be adjusted in order to enable to go with the technological developments. I just started, so let's see what the future brings. But yeah, that's exactly what needs to happen.
I mean, that would be great once we have the outcome, because then it will be also easier to comply. Because when you said that people, like the regulator is not the most flexible, especially for AML. For like Switzerland is a very good example. You can kind of argue that banking laws are not applicable, financial laws are not applicable, but AML, oh no. As soon as we have a doubt, it's going to be applicable. So it's quite striking there, and like especially in the Swiss context, we have this very annoying concept of assisting in the transfer of funds that is being interpreted in a very odd manner. So when it comes to DeFi, for example, you have many of these a bit more centralized providers that try to facilitate access. So anything that's related to facilitating access, keeping like a part of the private key, having like an encrypted version of the private key somewhere, be it in like a HSM system or whatever. Well, as soon as you have this, you end up with this question, what kind of control is that? And is it enough to create a dependency? Will the authorities consider that although you cannot control the funds yourself and that you cannot move them, you still are kind of responsible for AML things, like a requirement? So we create this landscape where, although strictly speaking, you don't have enough power to implement KYC requirements and have like the whole AML screening, you ended up on paper being subject to AML and would be forced to do more that you were supposed to do in the first place, because your setup potentially does not allow to have all this traceability. So they force you to have a bit more control, just because the way you structured it gives you just a small hint of potential dependency. So yeah, I'm looking forward to the ZK proofs part, because then it will be maybe less of an issue. We just implement a ZK proof system, and GVG4 would be a nice thing at the end.
Well, definitely. I hope then we would amend the regulation about video identification and the travel rule interpretation. We need to work on both of those things to make it possible. We don't have so much time left, but we have maybe a couple of minutes for questions.
Thank you. It's a really interesting topic, actually, because I was thinking about this a lot. If you think about AMLing different users in different pools in DeFi, it's not quite possible. There are no Zika proofs as so far accepted by regulators. So the question is like, if you're operating in the industry right now, let's say in Switzerland, in Europe, wherever, how is it possible to really do the AML and KYC for all the DeFi participants if you're providing the service as a central authority to the pools? It's not quite possible to make sure that there's no sanctions wallet there, and if there's interaction with sanctioned wallet, how do you make sure it's like, is it big enough if it's like $10 out of 5 million pool? Is it like, now all the money in the pool are bad? And yeah, if you can just like comment on that in the current regulatory environment, how is it just possible to operate without involving like millions and millions of costs and years of compliance? And yeah, I can go on and on. Thank you.
I think Magdalena will be the right person to give a centralized approach for that. But there's one tool actually, so I came recently across tools that allow you to screen the pool, because the approach we have most of the time is on transactions. But once you end up in the pool, like how do you assess how much of that pool is potentially tainted, and is it even worth risking tainting your funds by interacting with it? So there are now tools that allow you to, before depositing your funds, screen the pool and tell you, okay, 50% comes from flagged addresses, that kind of percentage comes from this. So you know in advance what is your risk exposure, and I think this kind of tools will be very efficient and like will change a lot, even in a purely DeFi setup. Because even if I'm not subject to any AML requirements or anything, I would like to know what I'm interacting with. Because it could be that then I want to interact with a protocol and my funds somehow got tainted because I deposited them in a pool where 99% was like originating in a hack, for example. Like you don't want this. So I think these kind of tools are the future on top of the tools that just really screen like the flow of transactions. But how it's approached by centralized entities, that's a different thing.
I think what I see out there in the industry is like providers, service providers, which are enabling compliance functions that you can then use in the respective smart contract or DeFi pool or whatever use case you have there. So there are already providers out there who are offering these services. Like having a partnership with them could be one possible solution. And building in compliance functions like automated through smart contracts is something that I have observed recently. But we are still at a very early stage, I would say. But this is definitely where the industry is going to when it comes to DeFi.
Banks, brokers, and SMSs in Switzerland have a lot of interest in depositing client assets into these protocols, but at the end they always say no because of AML. So what does it take for one of these to be able to say yes? How much more do we need? When is it going to be ready?
I would say that it might not be a comfortable answer, but I think the answer is regulation, because now that we'll have more clarity, especially in the EU, it's all about regulation, but at the end of the day, it's also clarity. And whenever you get a rejection that you don't quite agree with and you are quite convinced that you are actually doing things in a proper manner, there is now this tool saying, yeah, it's actually, I can assure you that I cover all these requirements. Either through using different encryption methods, because that is also a very big thing that is currently rediscovered through the like a separate framework around e-identity. So there are a lot of tools being built around ADAS. There is a EU digital wallet, and now all those encryption methodologies are far more embraced also by the policymakers, regulators, supervisors. So now we have this tool set, we have the tech that is constantly developing, and we can say, yeah, we are building this, so now you should reconsider your response because you're actually currently against the regulation, so we are allowed to do that.
And maybe before you have the regulation in place, and I guess it will take a while until we have a proper regulation for yield farming and liquidity pools. One thing is we see often financial institutions, they want some kind of confirmation that this is not against the law and this is not against any regulations. So if you're the creator of such a liquidity pool, or if you're behind it, you could structure in a way that it is compliant in Switzerland with Swiss law, and then have it confirmed within a no action letter by FINMA. If this is enough to convince the compliance team of your clients, of the banks or asset managers, I'm not sure. It's usually there's a discrepancy between the business people that see an opportunity and the compliance that looks at the thing and says, well, but now we have assets being intermingled with, I don't know, potentially sanctioned funds from North Korea, and there you would need an answer to, for example, with these tools. Otherwise, I guess it will take a while, yes.
I would just add, basically, we need an answer for what is enough, because we are used currently in compliance that we need to know everything, and unless we know everything, we don't accept it. So the question is, will some guidelines, some additional regulations just take into account those models where you can't know everything? I mean, we had examples of institutional pools where you need to QIC to even deposit. Usually, they are not the most attractive because you don't have enough liquidity, so you want to interact with the other ones. But then the question is like, how do I know that all these guys were not like sanctioned or something like this? So it goes back to compliance, and as you said, business opportunity, more liquidity versus compliance. We don't know what's in that pool. So as I mentioned before, there are tools, but the question is like, how much of the pool needs to be safe? Can we rely on the list that exists for flagged addresses? Is this enough? So once we have clarity on how much efforts are good enough to say, okay, these funds, maybe we don't know who they come from exactly, but at least we can have enough certainty that they are not sanctioned, flagged, or something like this. If we move to that approach, probably there'll be some progress. But the question is, will the regulator dare to go in that direction instead of saying, give me all the information you can, and then I will decide?
We have one very long waiting question here, but we need a very short answer because we are super tight, super over of the schedule.
Hey, yeah, thanks. This was great. I have a bunch of questions for a panel full of lawyers, but I'll stick to one. Yeah, I heard you guys mention a few times with immutable smart contracts, if there's no one behind them that they can nab, so to say, they can't really get to anyone. But I was wondering, in the case of Alexei Pertsev in the Netherlands, that was basically their defense, right? Where they said, yeah, okay, this is immutable, we can't do anything about it. And the judge then essentially ruled, and I know this isn't final yet, but the judge ruled this is an explicit design decision, and therefore you are not exempt of liability. Yeah, how is that maybe wider applicable?
So a very quick response. Basically, the judge in the first decision. Now it's we'll see what the final decision will be. But the judge went through different steps to evaluate it, and including how much Pertsev was posting on GitHub, how much was he involved with furthering the smart contract, developing it, plus how public he was about those activities. So in this case, those were taken as something like very similar to a company structure and a structure you would expect in similar circumstances if it were not a smart contract and if it was not self-executing. So all these little details led the judge to this final decision. It was not like the code itself in this case, it was more about the human attitude.
Thank you so much. Apologies, everyone. We are lacking the time, but feel free to reach them during the coffee breaks and the lunch break or whenever you feel convenient. Thank you very much for our panelists.